So gold isn't exploding right now. And that's exactly why you should be paying attention. Because on the surface, it looks weak, it looks anemic, it looks lamentable, choppy, indecisive, and almost like it's ignoring everything it's supposed to respond to. War risk rising, absolutely nothing. Not an iota. Inflation data, mixed to muted reaction. Central bank noise. Doesn't really care. But that's the illusion, because underneath all of this, there's a structure. And option traders have already revealed where gold is going to go next. The move just hasn't started yet. But by the end of this video, you'll see exactly where the pressure leaks. So let me give you the simple version first. Option traders are building positions at key levels. Market makers hedge those positions, and that hedging for market makers controls the price in the short term. It holds it in place, it pins it down until it can't anymore. Options traders have already actually revealed where the market is going next. But to understand what they're seeing, you need to start thinking in terms of a duality, a multi-layered market. And we're going to call it today the surface versus the actual structure. Now, they look very different from different angles, but once you start to understand what they actually represent, you will understand why the market does what it does and how price moves mechanically from one zone to another zone over time. Now, you might be watching markets and you may be thinking, what on earth is going on? Some days we have green days, some days it's choppy, some days we have no idea what's going on. It's oscillating in between levels and we're not really quite sure why it's happening in that fashion. But one thing is clear, these markets are often very choppy. They're very, very hard to predict, and they are very reactive in terms of the news. But that's what it looks like on the surface. That is the surface level machinations of the market. But what does it really look like when we're talking about this market in a mechanical way, where we're trying to isolate the actual structure of the market in terms of how it's positioned and how we can therefore benefit from it? Well, it goes in a few phases. You're going to have a few different price levels that you don't see on the screen, but are definitely there in terms of how people are deciding to allocate capital, where to allocate it, where to position, where to put their stop losses, and where to take profits. So we have our key levels down below. We have then our support levels of price. Let's say that our support levels for price for gold is 5,000, but a key level for it never to break is 4,500. And let's say our current price is about 5,100. Let's be optimistic here. So that's our current price. And then we have our resistance zone right up there as well. So at the moment, our resistance zone is about 5,500. Now, in those scenarios, the surface versus the structure is where we have to be looking next. Now, most people are still watching gold in the old way, the old narrative. War means gold goes up, inflation means gold goes up, fear means gold goes up, dollar down means gold goes down or up. Clean, logical, but sometimes, well, most of the time, actually wrong. It's completely misleading in the short term because markets don't move on the logic, they move on options positioning. And here's the part that most people don't like. They actually hate hearing this bloody piece of information. A lot of the data that you are told to trust, it's late, it's revised, it's wrong, or it's only one half of the story. Inflation gets recalculated, job numbers get revised or updated, growth gets reinterpreted. But positioning, nothing happens there. That's real. That's where money is at risk. That's where value at risk models are. That's where models and financial planning really exists. And right now, positioning is telling a very, very different story. So what do options actually have to do in this market? Let's simplify this before, quite frankly, I get carried away. So here is the very simple version. Markets are guided. They are not random. They never are. And to understand the different levels and how options actually affect them, we're going to have to look at a flow diagram. So let's create our flow diagram here. Oh, very nice. Now, in our flow diagram, we have our number 1, number 2, number 3, and number 4. Number 1 in this directional movement of how prices are decided is that options traders have to position. They position at specific levels in the market. There are areas of support, our current levels, and our areas of resistance. We spoke about that in the previous slide. Now, number 2, this positioning here feeds in to levels of pressure. They create levels of pressure around those resistance, around those supports, around those resistance levels. And they often appear as clusters of price, clusters of buys, clusters of sells, clusters of buys and sells. That builds the pressure in the system. And after a while, it leads us onto our next iteration, our next understanding, which is the market makers, we're going to call them MMs here, they have to decide which way to hedge. Now, they're going to be hedged directionally, they're going to be hedged against the buyers, and they're going to be hedged against the sellers. All of that obviously creates option flow. It creates more pressure to the point where number 4 is reached, which is our price. Our price gets pulled towards those zones that we mentioned before, right here. These zones are where price eventually gets pulled to. So gold isn't deciding where to go, it's being guided where to go. And the narrative model that we're working with is that war means gold must go up. But positioning the models, if you think about it in terms of a models from positioning points of view, then flows mean levels get initiated, which means prices get guided there. And that's the key difference, why prices are guided and not actually random. Options traders pick levels. They pick them above price, they pick them below price. They pick big levels, normally round numbers, psychological levels. And market makers take the other side of those positions. Now, here's the key. Here's the real rubric to all of this situation. They don't get to sit still, market makers. They have to hedge, and they do it unendingly, incessantly, constantly. And that hedging that happens all of the time, billions, trillions of dollars, that's really what controls the price. Now, it doesn't control the price forever. Nothing does. But it does for now. It does in the short term. It does in the fleeting, in the ephemeral, which is more than enough time for you to lose your shirt. But there's a magnet in this market. Think of price like a metal ball or a metal object, and the strike prices are like the magnets. So as the positioning builds up, those magnets get stronger and stronger and more forceful, and it can exert more pressure, and price gets pulled towards them increasingly, quicker, faster, more strongly. They hold the near-term price. It looks random for sure, but it's not random. It's controlled. It's gamma being pinned. It's price being held between two levels like a train track. And when the pull is strong enough though, the price stops trending and it ends up compressing in that situation. After we've understood all of this, why is it still the case that most people actually miss it? Well, let's discuss it by ranking these forces in order. What matters the most? So which forces here matter the most? So we can talk about it from a narrative model versus a positioning model. So our narrative model and our positioning model, what goes into both of those scenarios and both of those events? Well, in the narrative model here, we have the usual understandings of everything. You have your war, which most people think gold goes up, G up. You have your inflation, which again, narrative will dictate that gold goes up. In a market based on fear, the narrative model also assumes that gold goes up. And in a strong United States dollar, the narrative is that gold goes down. But that's the narrative model. Is it predictable? No. Is it short term? Yes. Is it unreliable?
Most definitely. But then when we move on to the positioning model, when we're talking about option flows, the positioning model is actually what moves price. Narrative is what most people use, but we've already established that it's not actually reliable. It's not repeatable, it's not trackable, it's not measurable. So what do they use in the model that is positioning based? Well, number one is going to be the option positioning. That's going to rank on maybe 80 out of 100. Next is going to be the hedging flows. That's going to represent a big number as well. If we had a number out of more than 100, 80 out of 100 would probably be where it's going as well. Our market structure is going to be, I'd estimate at about 65 out of 100 on a ranking importance. And then our news and our narrative is going to come all the way down here at 10 out of 100. As you can see, it's not insignificant, but by no means is it as significant as all of the previous or preluding variables. So option positioning is stronger than news. It's stronger than fear, stronger than inflation. It's what actually moves price. Option positioning is stronger than all of the headline risks. It's stronger than opinions. It's not what should happen, it's what is going to happen.
And that's what controls price. It's those flows. So if I've misspoken or I haven't made it clear enough, here's how the mechanism actually works. The options position, they build up. The market makers, they hedge the prices. The hedgers create the flows. And then the flows flow into what the price actually is. That's the key shift. Not price moving aggressively, but price being contained, suppressed until pressure builds up on either side. And the more the pressure builds, the more the pressure is stacked on each other, the more calls, the more puts, the more important the breakout becomes. And that's why the breakout is so violent, because on the opposite side, that thing has to unwind. The flows have to change. And this is where gamma comes in. I know gamma sounds like something radioactive when it can be to your portfolio, but it's not equations here, it's just intuition.
Theta, Rho, Vega, Gamma, Delta. I'm aware they all sound very intimidating and they all sound quite inscrutable, but yeah, they're not actually that scary. So Gamma, what does it actually do to price in these situations? Well, it's one concept, but there are two very, very different outcomes. And it's all about how market makers react and how they have to end up hedging. That's all you have to think about in terms of gamma in the market. I know many people want to overcomplicate it and make it sound like smarter than it is, but it's all about market makers just having to hedge. So let's talk about it in two different regimes. In a low gamma regime, and obviously in a high gamma regime. Now, in a low gamma regime, price might be wandering freely around. There's obviously less hedging that's going to be required. But in a high gamma scenario, you might think it would be oscillating more. But actually, price is way more suppressed and it is far, far more controlled. There's faster hedging going on, there's stronger hedging going on, and there's more reactive hedging that could be happening if prices move out of the regime it's currently in. Now, you can think of gamma as the throttle on the market makers hedging and how they adjust it, how they lift their foot off the pedal, how they apply the brake. More gamma means there's stronger price control. Less gamma means there's less price control. It's all about them protecting their positionality and not being wiped out in this market.
Like a spring being compressed, the more it gets pushed into an ungodly range, the more energy builds underneath it, foundationally, undergirded. And when the compression ends, obviously, the release isn't peaceful or diplomatic or with serenity. It's fast, it's violent, it's brutal, it's ferocious. So what are the options traders telling us right now? What are they showing right now? Because that's what matters. I mean, we just got some news out of the Straits that a naval blockade is happening. So option positionings are probably going to be going into a tailspin in the morning. Above price, below price, controlled zones, resistances, ranges. These are all ideas in options trading and on normal market trading as well. But it's where the price is being held, not rejected, not broken, but just held, pinned, consolidated, you might say. That's a distinction that matters in option markets because it isn't distribution, it's positioning. It's where all of the clusters of the buys and the sells are, where the flows are going, and how max pain is interpreted when price starts to go near to those prices. The vested interest, the people that really hold big money or aggregated real trader positionings around psychological level. So what are the option traders actually showing? Well, they're showing us the structure. They're showing you where the price is controlled and how it gets there. But more importantly, where it's likely to move in the next containment event.
Okay, now let's sum it up and let's map absolutely everything out and all of the important variables we need to see in the frame that determines just where gold prices move and, in fact, where all other assets move depending on options flows. So in the middle of our beautiful circle that I definitely did not draw is our gold price. It's positioned, it's held, it's guided. We know all of that now from our aforementioned slides. Importantly, right up here is the zone. That's the key difference between key put levels and key call levels. We have to also be cognizant of the break of those support levels. So when the break comes, that means the price is exiting the zone. The flows are all going to flip, and they're going to flip quite violently, and they're going to flip probably quite quickly, which leaves us into the move, the exponential move, the parabolic move, the move that seems forced. It seems like it's driven by fear, but it is, at the end of the day, directional, because all of the flows have to reverse themselves. Even equally as important is the next three things we're going to be talking about here. Now, that's an interesting interpretation of that shape that I wish to draw, but nonetheless, we're going to continue. Now, importantly, we have to be thinking about options positioning. If there's one thing you take away from this video and my messy handwriting, it's that option positioning is key. It shows where all of the strike clusters are, where if they're above or if they are below. Now, you can actually access that data, and I'll probably make a video about it another time soon. We have to start thinking in terms of gamma control. All of these other ideas are very, very key. All of them are key, but gamma control is literally the variable that decides if things are going to be high or held tight, or if they're going to be low and if they're going to be held loose. Gamma control is what these market makers are in the business of managing, profiting from, and ensuring is not out of whack in line with their positionality of their own entities and their own going concerns. And that leads us to our final consideration, which is hedging flows. Now, hedging flows are going to be very, very, very important because hedging flows are constant. They are mechanical and they decide absolutely everything. So headlines is not what we want to watch. Headlines are not what we want to watch. We don't want to watch headlines. We want to watch the structure of these markets, what goes into forming the structure of these markets. And that, my dear friends, is the map. That's the framing. That's the key understanding. And now you can definitely see where all of that pressure actually leaks.
Option traders are actually showing you something more imminent, something more important, something inevitable. It's the structure, it's the boundary layers, it's the setups, it's the positioning, because that's the system that truly matters. And in that system, price doesn't move when people expect it to move. It only moves when it's forced to move, when it has to move, when it has no alternative but to move. And that pressure is not gone. All of the narrative, the macro themes, the theses behind it, they're building. China, Russia, de-dollarization, BRICS, fiscal deficits. It's all there still. So you stop asking, why isn't gold moving? And you start saying, when will it move? Because it has to move. And now you can see where that pressure is building up. And if you've enjoyed this video, I wish you well.
Here's the bind. If they keep rates high during conflict, credit tightens, recession risk rises.
Here's the uncomfortable truth. You don't control monetary policy.
They bottom when everyone who wants to sell already has.